Funding for the Stoller Report is made possible by a grant from the First American Title Insurance Company of New York. The First American Corporation is the nation's leading diversified provider of business information products and services that impact the major events of people's lives.
Hello, my name is Michael Stoller, the host of the Stoller Report, Real Estate Trends in the Tri-State Region. The topic of today's broadcast is the insider's view of the real estate marketplace in 2005. My guests include Ken Swig, principal of Swig Burris Equities, Hugh Hall, COO, Chief Operating Officer of Gramercy Capital, Adam Popper, Managing Director of Beacon Capital Partners, Bruce Mosler, Chief President and CEO of Cushman & Wakefield, Richard Mack, Principal of Apollo Real Estate Advisors, and last but not least, Alan Riley, President of the Alan Riley Company. Last year was a very interesting year for the real estate business. According to a report issued by your company, Mr. Mosler, C&W's New York Capital Markets Group said that the total real estate investment sales last year rose to $14.3 billion as compared to $9.97 billion the year before, representing a 43% increase. But even more interesting was that sales in Lower Manhattan increased to $3.1 billion from $600 million. 2004 was a great year. 2005, we're in 2005, 45, 60 days over here. And so far this year, the Toy Building, 200 Fifth Avenue, 1107 Broadway has been sold. Properties in Brooklyn have been sold. Today, 200 Park Avenue is listed, a 2.6 million square foot building, which I always call the Pan Am building, the MetLife building. MetLife also put on the market 1 Madison Avenue. If you take into consideration what people are saying, the projected price that they will be getting for 200 Park, that's going to be $2 billion alone. It's going to exceed the highest purchase price ever. Where do we see 2005? Do we see it as another great year? We see interest rates going up there. Last year, one of the people who was really responsible for a lot of the purchases in downtown was Ken Swig. What do you see happening this year?
Well, I'm overwhelmed with all the stuff you've said. I see in the investment sales activity, I think the market's going to be stronger and stronger because there's a huge amount of capital that's looking for a place to go. I think the stock market is generally...
But the stock market reached a 3.5-year high.
I think generally it's going to limp along, plus or minus where it is today. And there's a lot of capital that's been divested out of the marketplace, both from Europe, parts of Asia, and also in the United States, out of the stock market, looking to diversify into real estate and hard fixed assets. And the trend started, after the downturn that we had a couple of years ago, and I just don't think it's reversed itself. The other thing about real estate is it's an asset that's hard to make disappear. It's hard to cook the books. It's hard to take a piece of property, and for all the problems that were going on with public companies and the reporting and the way they were announcing their earnings or lack thereof, real estate's a pretty simple business.
But,
think
let's look, and as you remember, the premise of the show in our 4th season is that everyone is supposed to make their comments, a little interruption. Isn't it true? Prior to the show, Richard Mack was saying to me that there are a number of properties available. And one of them is 1095 Avenue of the Americas, otherwise known as the Verizon Building, which is directly across the street from Bryant Park, and also directly across the street from the Durst new Bank of America Tower. Here is a building which is probably 25, 30 years of age, which according to the trade, a lot of people, probably 46, maybe 40 to 50 different entities, have evaluated it and looked at this property. In order for that property to be sold at the prices that they want, what kind of rents do they need?
Well, I think people have got to be assuming they're going to get rents for office on average in the 80s, 90s area, depending on how much you think you're going to have to spend to redo it. But I didn't interrupt, but I wanted to go back to where things are going in 2005.
It's supposed to be interruption.
I think Ken's points were right on target. I think there's two other things just to consider. First is we've reached a point where prices are so high that people who have been reluctant sellers are finally saying it's time to get gone. And that's happening across every type of product type in New York. So we're seeing this capital that is looking for a place to go, finding a home more and more because reluctant sellers are now putting things on the market. And I think just to give you a sense of what's driving all this capital that wants to get placed, it is true that they want to diversify and get into hard assets. But what we've seen over the last 12, 13, 14 years is not one down year in real estate. And I think that people get blinded after that type of recurring return to the downside. And the capital just keeps falling.
I mean, perhaps, Alan, who's been around the real estate market for many years, I'm not sure that over the past 14 years, we haven't seen one down year.
Well, I think it's down, Mike, but I think it's come back so much quicker and at such higher levels that we've now reached a level that we never were even approaching in the best years, the last 25 years, and we've reached a level of interest rates which are the best time to borrow that we've seen probably since the mid-1960s. And I think, to add what Richard said, that's fueling a lot of these purchases, plus, of course, the weak dollar.
I think Alan's right. It's a confluence of events. It's not just that we're at very low interest rates. It's not just that we have a weak dollar. It's not just that we have an extraordinary amount of capital in the marketplace, including the foreign buyer, which last year was about 28% of all purchases. It's the confluence of all these events that makes real estate so attractive, and including the fact that the real estate market right now, as against the stock market, which is volatile, is a very safe haven for investment. Look at the U.S. against alternative investments for foreign capital. It's a safe haven. It's all these things driving record pricing and low cap rates.
But you
have that also combined with a bunch of federal programs that downtown that spurred a tremendous amount of investment to spur future residential development. I mean, Liberty bonds have been for downtown residential development what the ICIP was for Times Square in the mid-late 80s. So there's all this speculative residential development that's going on. The early part of it, we're just going to see if it's successful. We don't know if it's going to be successful for 2 or 3 years.
Relating to the speculative residential investment, last year, Bruce's company, Cushman & Wakefield, probably had the largest sales price of a property. They sold the Plaza Hotel for $675 million.
It was the largest in New York.
And at $675 million,
I had to.
Was that C.B. Richard Ellis or so? No.
I don't even know the firm.
No, okay. But at $675 million.
Oh, cash.
650, yes.
With all of that, that's being converted.
Yes.
That's going to be converted, and that's going to be converted into residential.
Yeah,
and
primarily.
Primary with
Correct,
some
maybe
retail
and
so on.
Yeah.
But one of the things that Apollo Real Estate Advisors has done quite a bit over the last couple of years is have done a lot of real estate investment in the residential conversion and also buying land. Those units are going to sell for $3,000, $3,200 a unit. Somebody where you're bringing out Lower Manhattan, there are properties down in Lower Manhattan. The Cadwalader property sold for about $260 a foot, but they receive Liberty bonds, and they'll be renting it. Liberty bonds are only good for residential rentals.
Michael, with due respect, when you're talking about 3,000 a unit, you're talking about some of the most unique real estate in the world, overlooking Central Park. And 3,000 a unit may seem to be high, but on a relative basis, there's a limited supply, and in the world of supply
Bruce,
and
I
demand,
do
In
not
the most
disagree with you at
recognizable
all.
property in the
we
country.
need to keep this in perspective
last month,
to a degree.
I had Zeal Feldman on the program. Zeal had purchased a building at 823, 825 Park Avenue. Basically, the property was 48,000 square feet before he built additions. He paid $60 million. He paid, let's say, $1,400 a foot. As I said to Zeal, what do you project? He says $3,500 a foot. Now, it's a unique building. It's 12 units. You know, it's not 300 units. But let's look at it on the other side. As I think maybe Richard brought up before, when landlords who wanted to keep properties, a great example would be Wien Malkin. Wien Malkin sold the toy building. They owned the building since 1952. 205th Avenue over there, and then 1107 they owned probably for 30 years. They said, hey, it's a great time. It was the right opportune time. 2 blocks away, last year, Elad bought 225 Fifth Avenue, the Gift Building. Now, that's 26th Street. It's near Madison Park. The projections of the preliminary book that are going to offering are $1,500 a foot.
Michael, one of the things going on in the city, clearly, there's no doubt, is an unbelievable strong market for residential. And truthfully, it makes little or no difference where it's located, as long as it's reasonable. And the prices are not necessarily reasonable. And one of the things is you have to look at sort of the demographics of New York. In the 60s, New York City added 20,000 units a year to the housing stock. Today, we're adding 7,500 units to the housing stock. So it makes, in the best economic market, you're adding 7,500 units. The worst economic market, you're adding about 7,500
On a relative
units.
basis.
The supply has not changed in terms of what's being added to the housing stock in New York for the past 10, 12 years. So it's not, supply has been so factored out of the marketplace because there's so relatively few apartments being added to the market compared with the population that's coming in. And the demand is so strong that when you take that into the factor of this, the market is on fire. And until the demand truly diminishes, it's not going to matter.
I think there's also a psychological thing
Yeah.
going on here because I'm sorry, I don't want to interrupt, but yes, I agree that there's not enough supply, and that's why we continue to build residential into this market. But I am somewhat concerned about a market where there are few connections between the cost to rent and the cost to own.
The fundamentals.
Well, at a very high level, when you have unique properties, so if you look at Park Avenue or Fifth Avenue or some of the on-park sites that are now being developed around the city, you're just dealing with, you cannot rent that product. It doesn't exist to rent, and therefore it really needs to trade at a super premium. But when people start to build cookie cutter product, some of which we've built, and that product is trading with no relationship to what it might rent for. In fact, people are buying units and renting them for 3% yields. One has to worry how long some of that can sustain itself. And so while the demand is there, I am concerned about the prices being able to hold some of the more mid-level stuff.
But residential developers used to build condominiums with a rental backstop. They could build a condominium, and in worst case, they could execute a rental. If you, at the cost of land right now, you can't execute a rental. It's almost impossible. If you buy land for $200, $250 a foot, you have to sell it $1,500 a foot. You can't solve for what you need for rent for that property if it's a cookie cutter product.
Well, it's $250 a foot. You can sell for less. But
according to some people at Bellmark, there's 125,000 units that are filed with the building department in all the boroughs. Now, that's not going to be done tomorrow afternoon or even perhaps in 05 or 06, but that's a tremendous slug of supply.
The
honestly,
Williamsburg
it's really
waterfront is an
compared
accident
to-
waiting to happen.
Compared to other markets, though, really, I think when we're talking about the New York market, even if there's some speculation and some disconnection between the fundamentals, it's nothing compared to some of the speculation we see in other markets. As lenders, we look at stuff all across the country, and you want to talk about a disconnect, look at South Florida. I mean, that is just completely divergent.
Is it
And-
80% of buyers are speculators?
I've heard a
Well,
number
and
about
it's-
60%.
But it keeps churning.
But you know what?
It's
Let's
crazy.
bring up.
So New York, man.
No,
We're doing
no, no,
but it's
what-
churning.
I think what
I agree with you.
What you brought out and what you said before, Richard, is that there are people who are buying these units and becoming landlords. This is like in the 80s. I was with somebody yesterday, and he said, in one building, the Milan, which was built by Worldwide, there are about 50 units who are all being rented. And so they're $3,800, $4,000 for a one-bedroom. And this is not being rented by an established person who knows how to lease a property. This is being bought by an individual who said, I'm buying cheap, I'm going to do well. This is, as someone said, I believe one
And
of
so far they've been right.
Yes.
We sold out at $950 a foot at Greenwich and Spring. Those units are trading at $1,300 a foot now.
How long ago?
We haven't closed on all the units. People are only in 4 days and flipping
He's
and
current,
making
Alan, he's
$500,000. I mean, we're
you didn't
like,
you didn't change the plan fast enough. No, but
clearly you're right. And when we sell phase 2,
But it's still,
it'll be higher.
overall, I got to tell you, it's still a demand-driven market from users. There's people that are investing,
And demand is far greater
and
than
here's one of the
supply.
here's one of the things.
Yeah, we're not concerned about this
people,
market.
the residential market fundamentally used to be a market, and still is to some extent, where you're paying a premium to rent. And the reason you pay a premium to rent is because you don't have to put a deposit down, you don't have to qualify for a mortgage, and a bunch of other stuff that goes on. So people paid a slight premium in order to avoid that kind of thing. And the market now is shifted to the point where it's very, very expensive to own. But at the same time, people want to own.
People want to own a piece of the apple. They want to.
But once you get on the merry-go-round, right? Once you get on, and then you can go into the resale market. Then you are selling a product and typically buying a product in the same marketplace.
Just want to make
It's a
one-
California roll.
But you
It
have
is,
to get
but-
in, and
but I
that's
just wanna
what
make one
people are
point
doing.
on-
That's why a premium was always there
to
for rental,
piggyback off of
because you
Ken.
couldn't buy.
It is expensive to own, but the cost of funds today, the cost of borrowing has
absolutely
never
right.
been cheaper, and that is also fueling
Absolutely.
this,
You know,
If you have 40-year lows, what are you going to wait
let's
for
not
till you're
forget
80
that.
if you're 40 years
That's right.
old
Well,
to,
people look
to
at it
buy
and they say,
something?
But I'm
I'm
saying to
paying
you,
a
when you-
premium, but I'm also borrowing.
But when you factor in
At the best rates
at
possible.
the low rates they're borrowing at, it still makes more sense to rent. That's the problem. That's the disconnect I'm referring to.
Unless you have
Even-
an ARM loan, possibly, which you could
Or
be hurt.
Yeah, but a lot of
if you-
people need
the
to
reason you
own,
do it
too.
if you
So there's-
if you can
well,
own,
and
it's
that's
fine.
what's
but
driving
That's
the
what's
market.
making-
is
that's
a
the
psychological
connection, yes.
demand and desire to own that Ken
I agree. I
is
just
really
don't want to leave
referring
out the cost of
You
borrowing.
know,
That's fueling this.
I mean,
But actually, that
That's
really
the
comes into
underpinning.
play actually on the developer side, because
Sure.
if you look back 5, 6, 7 years ago and you were looking at, all right, I'm going to do a conversion like this, some speculative sort of project, it was much tougher to qualify for high leverage financing or much more expensive.
Right.
If you looked at development mezzanine money, sort of 75 to 90% slug, that was very expensive money, 5 years ago. That money today is very cheap because of the influx of all the capital and this belief all across the spectrum of real estate, be it on the equity side and the debt side, that it just only goes up. And so you've just seen a flood of money come into what is the speculative lending piece as well, which helps the developers be able to put these things together with a lot less capital in the deal, with a lot less of a commitment, and able to execute projects where their upside is enormous and their downside is modest.
Real estate today's taken on a whole different sort of meaning, ambiance. Did you ever think a Fidelity would include real estate in a 401k? I mean, that's really, I think, something unique.
But if
I mean,
you
we've
look-
reached a different point.
That's not
in
that's
terms of
unique
real
for the United
estate. That is-
States, but
for the United States,
But in
but-
Europe, people have had real estate in their portfolio. Institutions have had real estate in their portfolio as 20, 30%.
You're right, but real estate has been institutionalized in the United States for the first time.
It's
At
got a
least-
long way to go, though.
It
And that's
does,
what's driving
it does.
prices.
The
Absolutely.
thing
It's
that
not
gets me
investment.
is that you have such a tightness in the residential market, but you're still not seeing job growth in New York City. So it seems to me that you might be possibly on the verge
But, you know,
of.
let's get to
and
the job
income-
growth.
So you have-
before you
has to
say
be
that,
very high to
here's
buy
the
these
thing.
units.
Right, so I
if you
mean-
take a look at the Upper West Side, as just an
Where are they
example,
coming from?
year to year, this year, right now versus last year, you have 24% fewer apartments available than you did last year.
No inventory.
So forgetting the fact that it's cheap or expensive, there's nothing to buy, which means that people, even in these inflated high prices, unlike people who are cashing out of the commercial office buildings because this is a wonderful time to sell, people aren't parting with their homes. So you have fewer product on the marketplace. It's driving prices high, and you still have a huge demand that wants to buy. That's what is really going on in the city right now. And that's, for us, from Brown, Harris, Stevens, and Holstead, we're looking at when we sold the better part of $6 billion of homes
I was
last
waiting for you
year
to
here.
get that little.
I failed to say that he's also Brown.
No,
Harris.
but no, I only say that because
First
we're
American
looking,
title insurance,
but we're looking at this year on the Upper West Side 5% fewer transactions in number of transactions than we did last year. Price increase about 10% plus or minus, and more revenue
your
coming
aggregate
in.
dollars will be up,
But there's
likely.
there's nothing to sell.
Can
And
we move
the
the
interesting
topic
thing
to
Jobs.
some jobs, not the jobs.
you were
He
off.
wants to
I
go
wanted
to
to-
jobs.
Actually, I want you to talk to my lender on this new project I'm doing on the Upper West Side. Do you mind?
No. Since I know your new project,
Let's
and I
talk
think
about
it's
jobs and
No.
job growth. I think that's
true.
good topic.
let's try to get to some real estate areas. Otherwise, Richard said that Williamsburg, which a couple months ago I had Howard Wilbur on the show, chairman of Prudential Douglas Elliman, and he said this new property called Schaefer's Landing, the units are selling for $750 a foot. Why do you say Williamsburg is a nightmare?
I would love to have product to sell in Williamsburg right now. Right now, it's great. But when I think there's like 30 million feet of developable residential in that market, and the land is being priced such that they're going to have to sell these new units.
150 a foot.
Yeah, so they're going to have to sell 750, 800 a foot if construction costs hold. And if they all start building, guess what? Construction costs are going to go up. I think it's going to be hard to sell 30 million feet at $1,000 a foot in Williamsburg, as nice as it's going to be. So I think someone is going to
How
get
many
hurt out there.
apartments would that be?
When the
Whatever.
music stops.
How many? So that's
3,000?
30,000 units, right?
No, you know what?
30,000.
You know, we
Is
went
that
to
30,000
Williams.
units?
You know,
I think that's 30,000
we
units.
broached Williamsburg.
30,000
Now that's
That's a lot of units in a brand new market.
right. Since the show airs in the 5 boroughs of the city of New York and Long Island, or on the internet around the world, let's get to another borough, and let's get to a topic of both office and residential on what everybody feels about Long Island City. You've been quiet, which is surprising.
You get penalized.
You forgot when you were on radio, when you never stopped speaking.
We have not looked at Long Island City. We have looked at the other boroughs, and mostly we've been looking at residential and retail in the outer boroughs, and so I can't speak to Long Island City in
Adam?
terms of other products.
I'm a little less sanguine than some of my counterparts on Long Island City. I think
That's the idea. Everyone has to give an honest
I think
opinion.
that they first have to solve better access to the waterfront. I think that they have to fix the transportation issue, because the best part of Long Island City is extremely difficult to get to. They have one train that brings you to Vernon Jackson. It is 2 long, windy block walk to get to the waterfront. And until you solve that problem, then the rest of Long Island City can't be developed properly, because other waterfronts have better master plans. They have better access to the waterfront. There are better amenities on the waterfront, and they build from the waterfront in.
So you're saying on both sides, you're saying on both residential and commercial office
Get the
building,
same problem,
you have no,
infrastructure.
I'm not disagreeing. I'm just trying to get an opinion. Alan?
Well, I think that you can look at it too as in London, when you go across the river there, that's being developed on the east side of the river in London. And as long as you can get there easily, I think, and if the zoning is encouraging, which it only recently has, we haven't really given it
Right, the
a
zoning was
chance
just
yet.
approved about a
But
year ago.
I look towards those new buildings that are on the water there, and I understand there's going to be a lot more. The lights seem to be on.
No,
in most
those
of
are
the apartments.
the residential. I think
Yep.
what Adam in a previous life was with Tishman Speyer, and Tishman Speyer has made a commitment that they're planning to build some offices. I think they're the only people planning to build offices in Long Island City. I mean, you have, as I proverbially call it, the Jolly Green Giant, the Citicorp building, and then there's the second Citicorp building that's being built, and I don't see too many professionals. I don't see. I mean, I
Tishman
realize
Square's
you
also
have
building
people.
as
No, we look. I think Adam identified the single biggest obstacle to Long Island City becoming attractive, and that's infrastructure. That said, I wouldn't, bet against it because it wouldn't take a lot. It won't take a lot if there's an investment in infrastructure to make it attractive.
I think it's going to be
on
terrific.
On a very
It should be
fundamental
terrific.
basis.
Absolutely.
The rates that they can offer and the product that they could build, and if you put some infrastructure in, time-wise, transportation-wise, it could be very attractive. There's an investment that has to be made first.
But how are you going to do that
That's-
with all the
that's-
other needs of transportation here? Where will the money come from?
Well,
for
we-
all that?
You
That's
could
a
open
separate
if
issue,
you open
Alan.
up the
It's-
7 train on the
There
waterfront
you go.
instead of on
There
Vernon
you go.
Jackson,
There you
you had
go.
one stop. You bring the N and the R train down towards Vernon Jackson, as opposed to letting it just stop on Court Street and let it swing over.
and the 7 has to be built.
And
for
you
a
don't
lot
have to
of
build.
reasons.
Right,
I mean,
and
the
the 7
train,
has to be
the tracks are
extended.
there.
It'll
I mean,
happen until when
and-
the infrastructure, it'll follow when there's no need for it to follow right now. Because infrastructure usually follows demand
Yes.
as opposed to creating the demand. And that's the way our infrastructure has been there. When you use a lot of pressure, ultimately it gets. But I got to tell you, one of the good things about that, and just residentially if you look at it, is it's a combination of suburban living and urban living. You're in an urban high-rise area, but you can build outdoor swimming pools right now because of the way the land costs are. You can build outdoor swimming pools. You can put an outdoor tennis court. You can and it's typically a suburban environment of getting to the building and not. In other words, you're driving and you're parking in a garage and you're coming up through the building like you do in other suburban markets, only you're in a very urban area with a magnificent view of all of Manhattan. So, 5 to 15 years is going to be.
Yeah,
I think,
but
a
very
city.
realistically, if you
Very
look at it in
wonderful
order
place.
of priority,
It'll be the fourth
Long Island
downtown of
City
New
is
York.
going to follow downtown, Jersey waterfront, Brooklyn.
Let-
It's not on the A list at this moment.
Bruce,
And
since you
But
just
it's a great
spoke
land
about
bank, one of the great
following,
land
Order of
banks.
magnitude, it's-
Great place to buy and hold.
I'm sitting
Yeah.
here with a couple of people who have owned buildings, buy buildings, evaluate what's downtown. And I have one person who owns 5 office buildings downtown.
Who would that be?
I'm not certain. But this gentleman has made a commitment to downtown. My question is that a lot of people have gone downtown, and as you said prior to the show, people go downtown because of the cost savings. $20 a foot, $30 a foot.
That would be the number one reason why they go downtown. But I think that's going to change. Also, right now, let's be direct. Downtown and Midtown sort of run together. As Midtown goes, so goes downtown. And right now, the rental gap between Midtown and downtown has never been greater. It's approaching almost $20 a square foot.
And what about the
That's-
incentives? What if you add the incentives in?
The incentives-
but they're gone. A lot of them are gone. But that made it even
They
worse.
have been, well,
With
that's right.
incentives-
in
That
terms of the
created a lot.
discrepancy. The discrepancy is so vast, right? now.
Downtown's turning a corner, though. Is the point that I'd like to make. I think that right now you've seen a tremendous amount of conversion from office to residential. You've seen a huge influx of interest in retailing for the first time in several years, I think.
Yeah,
And
BMW
that-
is opening up
that-
downtown.
Every luxury brand is
Yeah,
looking
no.
downtown right now. That's a very positive statement. I think downtown, last year, over 1 million square feet were leased downtown over and above the prior year, net. 1 million square feet of incremental absorption.
What happens when the 7 World comes on the market, the Freedom Tower comes on the market? What happens with this additional space?
It's good news for the
Well,
marketplace.
yeah,
Good for
you
them.
need to
This is a-
segment
this
the
is-
market.
yeah.
It's product that they haven't seen. We haven't
Exactly.
seen new column-free product downtown in, I can't remember when.
Big space.
So
Big space
for
used
the
as large.
institutions, this is sorely needed. And will it be absorbed all at once? No. Will it take 18 to 24 months to be absorbed? Yes. But is there need and demand for the product? I think so.
Well, I mean, I think if you look at Midtown,
Adam,
there's no,
Now,
there's no
the
block-
question is how much.
There's no blocks of
you
space
can't-
in Midtown,
you,
right?
You couldn't handle 10 million feet of new
What
product.
they're not going to do
Right.
with the World
But-
Trade Center,
but-
the original ones that went up
That's
the Twin
right.
Towers.
You can't.
Question
You
is
can't.
how much?
There's no large blocks of space in Midtown. I think over 125,000 square feet. There are 10 blocks of space in Midtown Manhattan.
Less than that now.
So if you have
But
less
there
than
are
if you have less than 10,
there's quite a few projects that are coming up
Yeah, but
in
you have-
Midtown,
you have-
and there's going to be just 1095 a million square feet. So
but
the million square feet and
seven
million
World
square
Trade
feet
is
of-
going to beat that.
but that's
they're,
a million
they're the first
square
one out
feet.
of the box.
yeah,
I don't think that. I think that the Midtown can absorb 1 million square feet of speculative space.
Well,
I don't think that that's a problem.
it's going to be more than that. But I agree with you. Only thing I would say is I just don't think downtown is there yet where it's going to be great margins on new construction. Now everything's
For
timing in
office?
life. Yeah,
Absolutely. You're right.
I mean,
Yeah,
so
but
so I think the Freedom Tower is going to be ahead of itself.
But he's got a
Ultimately-
different basis a little bit.
Right.
than
He
others.
does, and
Right, but-
that's the very important part of the equation.
Ultimately, if you can turn downtown into a 24-hour community, which I think is going to happen,
I do too.
if you can create the amenities, restaurants clearly are there, retail is coming in a bigger way, but you're going to need community institutions, you're going to need art galleries, you're going to
Schools.
need schools, you're going to need
Yeah.
more parks, and when all that occurs, downtown is going to have a very, very different
Can I
flavor.
tell-
And it's all just
you're right,
timing.
and here's the interesting thing about downtown. You know, we're all from New York, and in the real estate business, we're all supposed to, keep up on this. It's unbelievable that it's unbelievable how much is happening that we really don't know day to day. For instance, there's 17 new parks that have been created downtown in the past 3 years. 17, 14 of which are completed, 3 of which are, either completely renovated or brand new parks. Nowhere else is that happening. The transportation system, all this stuff. I think the perception is lagging the reality, but it's still anywhere from 6 to 30 months before all of it, really gels. But if you look, there's more railroad tracks per square foot there than any other city in the entire United States, including Midtown. Okay, the delivery system, the subway stations themselves, the state, were terrible. Now you have a brand new PATH station. You're going to have a brand new Fulton Street station.
That's
You've got
key.
2 brand new ferry terminals, one of which has been completed. That I would venture to say most New Yorkers don't even know existed, much less that was completed. All of this stuff that's finally
Ferries,
coming
you
on.
know.
And so I think that until people really get down there, where I think when spring hits and summer hits and people start to go out and they start to wander around in good weather, it's going to be a whole different place. And then I think it's finally going to.
No, but
Again,
Ken, it was
but isn't
50
it-
years since infrastructure was invested in.
It's probably, Dan
downtown.
Darcroft talked
So-
about the fact that in the past, I don't know what it was, 50 years, that New York City has had a net loss of 12 miles of railroad track.
Yes.
Okay, before the train went out to JFK.
Let's
And
cross
that
let's
that's
cross the
all
Brooklyn
changing.
Bridge. Let's go cross the Brooklyn Bridge, and let's go to Brooklyn, downtown Brooklyn. Adam, you're with an entity who's going to be buying, has a big checkbook, who wants to buy some property. Would you invest in downtown Brooklyn, in the office and in the office, because you're not really in the residential business?
I had to get this question, sure. I like downtown Brooklyn. I think it has the infrastructure that's similar to downtown Manhattan. I think it has a residential base, it has a education base, it has an amenity base. I think supports bringing employees to that workforce. But I just think it's not going to compete on the same tranche as the core office tenants of downtown, and especially not the core tenants of Midtown. I think it's going to be an
Has to be
alternative.
economic.
It's going to be
Yeah.
economic.
But
it's going to be an alternative.
but
It's going to be
Bruce-
an alternative to
Michael,
a suburban
All right.
alternative that is urban
That's
in
right. I mean,
location.
you-
The stuff we've seen down there, I mean, the retail I think is great, the residential I think is great. The limited office stuff that we have looked at there has not been any kind of cost savings. So there may be some
costs the same
special
to
use
build
tenants.
on both sides of the river.
Exactly, and so there's some special tenants who sort of have to be there, you know, courthouses or
In
whatever.
fact, the
But
rent-
didn't you
the rent was higher in
just
down-
make a loan?
Not in an
the
office
rent
building.
was higher in Brooklyn than it was in downtown Manhattan. a couple
And
years
exactly,
ago.
and we were looking, they were pro forma, they needed higher rents than in downtown.
And they were
At the end of
getting
the
them.
day,
They were achieving them.
That's
But they're going to have
long term.
But they're going to have a stadium there, right?
There was a lot of subsidies going on.
Yeah,
Yeah.
that's right.
But wait, let's talk about downtown Brooklyn. I mean, your company did a loan downtown
At Ratnerville?
in
We
Ratnerville.
did a loan to
that in a city,
Forest C. Ratner, although that's a bit of a special project. At the end of the day, on the downside, that's a big box retail residential play, and who would you rather be doing a project like that than those guys? They already control 3 of the 4 corners at Flatbush and Atlantic. They've been very successful in developing that type of product around there. So
So you
it's
have an
really a special
alternative use in
circumstance.
case the other project doesn't work out.
Honestly, if the Nets Arena comes, that's great. It's fabulous. We have a pretty straightforward takeout. But at our basis, with this sponsorship, it's not essential.
Since, this is real estate and the Nets Arena, let's bring up the stadium. Where do we see the stadium and the West Yard Yards in
Why
this
we laugh?
market?
Because you said you were
We're going to have some different
I
opinions.
said
I won't talk about the stadium.
I said
but
at the prior to the show I wasn't going, but we got to a stadium and the
had to
Javits
bring it up.
Center and everything. I had to bring it up. Mr. Mosler,
Well, thank you for this question. Well, look, I have a biased opinion on this because I think that
Because you like the Intrepid.
no, as a matter of fact, because I liken this to anything else where it's a supply-demand issue. The Javits Center is the 17th largest convention center in the country, which is ludicrous for a city like New York. We need a bigger convention center, far bigger than is proposed for the expansion of 150,000 feet. The Jets Stadium would serve that purpose. I think that the issues that are on the table now are not the issues that should be the ones that are discussed. It's 8 to 10 home games, so it's not a traffic issue, it's not a congestion issue. It's, should we have a stadium and should it be publicly funded? That's the issue that's out there, and I think that when you look at the investment that the Jets are prepared to make, when you look at the benefits that it brings to the city and what will happen around it, I think it's something we should seriously consider, independent of the Olympics.
But in addition to the stadium
How about
is
independent of the Javits Center? I mean, do you really think you have to have those two together? I mean, because obviously there is another scenario where you could say, fine, the Javits Center is clearly economic,
Yeah.
clearly something that could be done theoretically in and of itself, and it's really been trying to push all the pieces together to get the momentum for the whole project going.
But
in
yes,
the
But
Olympics,
if you
the
can,
Javits
if you
Center
can
is-
find
to the center, too.
a use
Alan?
that serves two purposes,
Alan?
I just-
leverage it. That's what this is about.
I think my question wasn't really the stadium. My question was really
Oh.
the entire west side, the yards, the concept of residential. Because I think a good example is what Kent was talking about on the west side, the upper west side, anything past 57th Street, because of the fact that there are no housing and people. Look what happened to 8th Avenue. Look what has happened to 10th Avenue in the 40s.
I
All
think
those
this
buildings.
Is, this is all a testament, and I don't want to, congratulate our politicians too much, but I think we have a quality of life.
We are on the City University Network.
Yes, but we have a quality of life.
So we should do it.
in New York City.
I'm not
that's never
never.
been better, and
Yeah.
I think it has a lot to do with the reduction in crime. I think there are things that still need to be done in terms of education, but there are no bad neighborhoods in New York anymore, and we've had a reversal of people saying I'd rather live in the suburbs, just people saying I'd rather live in the city. We also have a lot of demographic factors with the baby boom generation becoming empty nesters and wanting to move back to the city that are extremely positive for New York and for
And the
city.
rest of the country. The
the rest of the
reurbanization
country.
of
That's
a
right.
lot of the United States
That's
is
right.
happening in
And-
all
and-
major cities.
And
But
so,
you
I mean,
know,
I think
we-
that you've got, you have this huge factor of quality of life improvement, and all of that is making real estate guys in New York look real smart. And I think that there's no place in New York City that can't withstand residential. I think there are infrastructure issues.
Well, you're not going
which
to
will-
relocate any people over there, too, which is really a crazy.
I mean, it's the last piece of the great
we
development
also
puzzle,
have to-
right? I mean, the West Side yards. It's the last great development puzzle.
I think
It-
definitely something
And
should be
it's
developed.
any-
There's
exactly.
not a question.
Right.
We're not
There
putting
should be
this in
development. I mean,
perspective.
Right.
You're talking about a site that would not have development begun, till 2010. You have to first. You got to put infrastructure in there, and you got to do the 7 line. You got to do some other things. But you're talking about a site that, looking forward, makes enormous sense, and it's a mixed use type of site. You'd have residential, you'd have commercial, you'd have retail, you'd have all. It's a 24/7 site, and if we don't develop it or begin to put the investment in infrastructure, then ultimately I think we're making a huge
I
mistake.
think the
question
commitment has
also
been
is-
made
Yeah,
to
but-
develop it. I
yeah,
think the
the
question
question
is
is this
what,
also.
what is being
Would-
what's part of the development.
Would the 7 line or anything else really be put in at the same time if this was private development, just an expansion of Javits,
No.
and somebody going in and doing it? And that's true. No, I don't think it would be. But what the city is doing and saying is this: if there's a public program, be it the Jets and Javits combined, with maybe the Olympics looming, we're going to build the infrastructure for the 7 line. We're going to do a lot of things that will really set this area up for private development to go around. So the other aspect of it, besides an emotional aspect of it, it's wonderful to have a football team in the city in which they're named after, the New York Jets. The other thing is that if you look at the public infrastructure and you've got Cablevision or others saying that we're going to do residential, we're going to do this, I don't think the 7 line would have been a factor in there, and I don't think the city would have been talking about doing that. So if this also helps, and it's one big block, and it'll hopefully be a wonderful, great project, and it'll look good, and it'll have street activity, etc. But the city's also going to commit to a very large infrastructure support, which will open up a lot of the west side.
That's crucial.
That is a big thing, and I think that impetus is a very important thing for the city.
I think it's very, very hard to view these things completely in economic terms. Did Central Park make any sense? I mean, economically, it didn't. I don't think you could, but there are certain quality of life things that one has to face up to. What do we want our city to be? How convenient do we want it to be to go to a football game? And do we want people to drive out to New Jersey? Because I just think it's a quality of life thing, and it may not be economic. We missed a huge chance to open up the waterfront on the west side by burying that highway I guess it was probably 30 years ago. There was a great opportunity for New York City to redefine itself. And I think if we had done that, the economic stimulus created by that parkland and that highway would have really helped downtown. First off, but would have created a better
I think a great example
is
look what's happening in Chelsea. West Chelsea, the prices of apartments are renting for $55 a square foot. They're selling for $1,300. It's one of the hottest neighborhoods. Jeff Levine was on this show last month. So areas, as you said, and I think it was Jerry Spire who may have said it also, there are no bad neighborhoods. The other day I was catching the beginning of the 1990, I think the 2000 version of Shaft. And it was up in Inwood. And the idea was, that was called Inwood and Washington Heights. And if you pick up the New York Times or real estate section, that's Hamilton Heights. And Hamilton Heights.
There's new construction.
Up
there, by the way, now.
For $600 a foot, you can live in affordable housing, in affordable rental purchase in Hamilton Heights.
Named after Alexander Inwood?
Exactly.
They've changed the term. It's all this. And I think relating to that, let's go up to an area that I've spent a lot of time because of my philanthropic involvement, Harlem. Harlem, I think when Grid built Harlem, USA, and all of what the city did, and this is not to talk about, with New York City Housing Development and everything, with all of the anchor programs to build the apartments, Harlem is growing. I mean, north of 96th Street is a dynamic area. I mean, I realize, you're one of the bidders and a variety of other bidders right next to the Apollo. And I think Harlem is a great area for residential, retail. I'm not certain about office.
Well, my prior job, we did the financing in Harlem, USA, and the reality is these the retail projects like this are just tremendous success. I mean, I think, you sort of overlook a little bit some of it, given that you have a focus on other markets, maybe in general. But we did the Harlem USA at my last job, and then we've been recently looking at stuff in downtown Brooklyn. And the reality is the retail in particular is just incredibly strong. It really stacks up against just about anything.
I mean, put it in perspective, if you talk about apartments selling for $700 a foot, that means that a nice size one-bedroom apartment that's 1,100, 1,200 square feet is like over.
That's 1,200 square feet.
Maybe it's a large.
That's a 3-bedroom in
no,
apartments,
but
right?
I'm saying a large. I'm saying a large.
Two bedroom.
2.5 baths.
Apartment is now over. It's $1 million.
That's a good one.
$1 million. Don't forget, $1 million still is a lot of money to spend on an apartment.
Is that on 57th Street?
It's not a lot.
It's a huge amount of money to spend.
Right.
when
So
you
I'm
think
just
about
saying
it.
that you're talking about apartments in northern Manhattan selling, whether it be Hamilton Heights, or Harlem, or for close to $1 million or over $1 million for large one-bedroom to two-bedroom apartments. That's a lot. That means that there are people who are priced out of neighborhoods and they're moving to other neighborhoods. That's why people are buying condominiums in Hamilton Heights.
And if you're looking at buying and you think it's a good buy at $1 million, it's frightening to think about. But you have to fork over $1 million and you think you're getting a decent buy.
Adrian Albert of the marketing
I'm
directors.
just saying, I'm not disagreeing that it's not a good buy, but
is.
people have to feel that they have their family grows. They got to live somewhere. They have to commute to work. They can't, So the old equation is that if you had to spend a lot of money, you would first go out to the suburbs, right? But the suburbs are pricing themselves out too. Everything's getting compressed. You can't, so $1 million to live in an apartment in Hamilton Heights may not be a bad deal relative to the alternatives, and you might not have a choice.
Well,
And
I think now we're bringing up,
It's
another big problem is that how do you create affordable housing
Absolutely.
in New York City? And
For your young workforce.
Right.
Remember,
Well,
this is a labor issue.
this is
at the
good.
end
This
of the
is
day.
right. This is going to be a problem in the long run.
That was
right
always
now,
the-
it's great for
that was the
developers,
rental
but we
housing.
got a
That was
problem.
with the rental housing market, typically, and the starter housing was always rental, and then they'd ultimately launch into trying to buy.
And
product.
if you
can't
and
build any
anyone
more
we
rental
have to
housing.
be very
And
careful
the
that
problem
the
is,
city
right,
continues
it's
to
hard
attract
to
a
build.
young,
That's-
bright
that's hard to
labor
do.
force.
So, but
Exactly
relating to
right.
this, a young, bright labor force, somebody who comes here and is earning $40,000 or $45,000. Not everybody has their MBA. We had somebody on the show last month. He says, you're making $150. You can afford this apartment in Hamilton Heights. I said to him, let's be realistic. There are
Not
people
everybody makes
earning
$150.
$40,000, $50,000, $60,000. People used to
Lots.
spend 30%.
Most.
Right. They earn and they can't even go to Queens. The newest development, Cord Meyer's project development in Forest Hills, is selling for $700 a foot. Rockaway.
Taxes in Queens on single-family homes are $600-700
The problem-
a month.
Buying
there's
apartments is very hard in today's market to build an affordable. But the thing that you want to.
But we have a
have
labor
to
force. We
invest
have to
in
bring
rental.
people.
We
People
have
work
to.
for
Exactly.
Cushman.
It's gotta
People
be-
work for
we have to
Swift.
That's
invest
what
in
you've
it
got to
and
end up
incent.
first to be able to also build rental housing that's affordable to
That's
come
right.
in, because the 22-year-old people to 35-year, whatever it is, age that are coming in and entering the marketplace typically don't buy first, they rent. And right now the rents are plus or minus 50% of your after-tax.
Well, I'm going to say something very
and that's
controversial.
the
Yes,
point
please.
at
So
which
I
you really
think
can't cross anymore.
I'm not necessarily in favor of kicking people out of their homes, but I think a lot of this is rent stabilization induced. And rent stabilization, to be quite frank, is the best thing to happen to developers, because there's an artificially low supply. People are consuming too much rental product for their needs because of rent stabilization. So
You've
you've
got
got
a million apartments plus or minus that are still rent stabilized.
you've got people who, their primary address may be New York, but they've got a house in Florida and they have a rent stabilized unit.
Well, there's a
And
procedure
that's
to-
I think
But
that's
is that the
There is a
crux of the
procedure,
problem?
Alan,
That's not-
but not everybody
that's not-
knows
that's
how to
part
take
of
care
the
of this
problem.
procedure.
I would
That's on
submit
one end,
it-
but the real thing is
I-
also is that how do you build, and now so they put programs out, 80-20, right? So if you have
Right.
80% market rate,
That's a symptom.
you have 20% subsidized housing.
Yeah,
in
do you-
there.
do you
But
want
if
me
you
to
take
tell
a
you
look
how-
at the
You
numbers
can't afford to do that
of what
anymore.
but if you even look at what the 20% subsidized people are making a lot of money.
No, wait, no.
It's
Kent, it's in certain areas. The building, the Helena,
Still.
which Durst is building
On
today,
57th
on 57th Street, the 20% units, you can only earn up to 60% of the area median income.
Correct.
That's 64,000. 60% of that is 36,000 for two. So
depending on where it is. You're absolutely
yeah, but that's
right.
over
But
there.
the
So,
incentives don't work anymore. Tax exempt financing in a market where interest rates are low, the differential doesn't help you anymore.
It's no longer the 5-point difference.
That's
But going back
number
to
one.
what-
Number
going back to
two,
what-
land is too
Right.
expensive
That's
to build
an
rental.
issue.
So we've got to address how we figure out a way to make rental an affordable product to build. Again,
To
in this,
keep
in
our
this
young,
market.
bright
That's absolutely
professionals.
right.
Rich,
And
I think you really hit on the head.
From
I mean,
working
the
in the city.
experience in
Yes.
Cambridge, when they took out rent controls, actually average rents went down, of course. So the reality is exactly what you're pointing out, was
Adam,
that there's a skew
Back
in the market.
in the late 80s, early 90s, when kids graduated from college, they moved up to Dormandy Court on 96th Street and 3rd Avenue. They stayed at the High Point. You had two
Waterside
people.
Plaza.
Waterside Plaza. You had 2 people in 2 bedrooms. You had maybe 3 people in big 2 bedrooms, and it was feasible. Across the street from Normandy Court is now high-end luxury condominiums.
And those kids are in Brooklyn and Queens now.
But Brooklyn and Queens are now condominiums also, and people are built. There is no.
I was in
new
Crown- I was in Crown
Let's get
Heights
beyond
yesterday.
them
So you
to,
can't
to
get-
young
so you-
professionals
right, so you can't
that
get-
are making the 150. There's not a lot of alternative for them either in this marketplace. You can take this and just ratchet it up a notch or two,
What
and,
about-
and there,
but
we
what
have
happens-
to be concerned
But
with
what happens to
housing
your
Very,
in the
very
city.
concerned.
when your clients want to grow, and they want to expand? There's been
Yep.
relatively flat job growth, and they start thinking about their business plan for growing,
They should
they
come
have to
to our
hire more
buildings
people.
downtown.
Demographics
And then they
become
start
a
saying,
key issue.
right, and
No
then you start
question, they
saying,
should go down.
how are we going to grow our
That's
workforce?
why I've risen
Where are
the
they
point.
coming from?
It's a
right?
key issue.
You
It's
can't
cost
recruit
of
from
labor.
school.
It's called.
If you're recruiting from colleges and from business schools, and you say that for $150,000 a year salary, which is a really big salary coming out of business school, right? You can't live in Manhattan,
right.
right?
It will affect.
And
the
we
long-term
have an
growth
opportunity with the
and
West Side
commercial.
yards, with Williamsburg, which is still in the ULURP process, to figure out how we create affordable housing in some of these areas. People who have bought
And then
land
you
in
have to get the
Williamsburg.
transportation to and from.
Well, the
that house.
transportation's
5 or
okay in
6
But you
Williamsburg.
know what?
away.
But people who've bought and speculated on land in Williamsburg have had a windfall. So to
They
me,
were in there for $5 a foot.
okay,
Some of them.
that's
correct.
a windfall. You
No
know, and
question.
so to me, I don't think it's super unfair, okay, to create in the ULURP process, some affordable housing, because if we don't create this affordable housing
It's
someplace, the economy just
Do
can't
you
grow.
do it through incentives for the people building it, or do you do it as a penalty if they don't? And that's really, the more incentives you can create, the better
I
stimuli
think you
you're
build
gonna get.
incentives and you
And
allow them
that's-
to build
You
more
build it
apartments.
into the master
Build it
plan.
into the
That's
master
so to
plan.
speak,
But just
right?
so if you do
So
it
you
through,
don't want to.
Well, when
No,
you
no,
give
if you do
someone
it through
huge
incentives,
upzoning,
you-
you can.
No,
You
but
can
what I'm
afford
saying,
it.
if you do it through an incentive,
If you give the upzoning, they can
then,
afford it.
Then you
That's
can,
when
then
their
you
land
can do it,
costs.
and that's
So-
the way.
so allow them to build
business
40
works
stories.
today.
But it's not really clear what the affordable housing requirements are in Williamsburg. They need to clarify that. They really need to take the opportunity there when you're bringing 30,000 units on to make sure a lot of those are affordable. And right now, it's not clear to me that that's
But
happening.
you could do the same thing for Long Island City. I mean, if you
agree.
built
Be
moderate
a great
priced
place to
housing
do
in Long Island City, if you look at Manhattan 96th Street, where that was where people rented their apartments when they came out of school, and I'm not just picking on that street, but that was such a hotbed of where people went
It was
when they
also
graduated.
that was the-
something
that was
on
college
the
dormitory
far, far
too.
west side.
Right,
The
I'm
point
just-
is, you've got to plan to do it.
Right, but once you do that, look at what's happened only 15 years later. You now have luxury high-end condominiums there. So if you want to bet on the future development of Long Island City, which is going to be around for a lot longer than 15 years, then if you can spur the right master plan on the waterfront, you can bring not only just $1,000 foot apartments on the waterfront, but if you can put affordable housing in Williamsburg and Long Island City and Brooklyn, and parts of other parts of Brooklyn,
Alan?
I think that you're going to have a long-term beneficial effect for the expansion of those boroughs.
I think you have to remember that a lot of these apartments were built under various FHA federal government programs, which don't really exist now. So the city has been bootstrapping a lot of this. A lot of it was following the 9/11, but without the federal government pitching in here, I don't think you're going to find an
That's-
ultimate
Well,
satisfaction.
that's a key
That's why
point.
you
I
have
mean,
to
the
stick
city
the incentives
relies
in, because
too
then what
much
you're
on real
doing
estate
is you're
taxation
figuring
right
out a
now
way that the
to
city
meet
can
the
give
budget
something
debates.
that doesn't cost anything.
Yeah.
It doesn't cost that. If you do X, Y, Z, you get this. If you don't, either two things: you get nothing, or if you do it, you get an extra thing, and it doesn't cost the city money to give an incentive
I mean-
like that. And that way, private money funds in the subsidized housing that you
if
need.
the deal is made up front.
I mean,
through the ULURP
yeah.
process or through whatever it is, the rezoning
the
process.
only way.
Because there's no money to give out.
Right.
So you can only do it through enticing private development, or without it, then you can't get any upzoning. And that's the way I think we have to start looking at our land use. It has to be, land it's only so much of it, so we have to figure out how to get some public good out of
Well, that's what they're doing
out
in
of using
Florida
the
when
thing,
they
and
charge
that's the
developers money
balance
to
that we can create.
build
Trouble is, we're
highways.
bumping up against a city that has all kinds of budgetary issues.
Yeah, but it doesn't
right
cost
now.
anything
Can't-
to give
But the
those
city,
incentives.
the
That's
city
why.
is in the best
That's- you
shape.
don't have-
It's
it doesn't
been
have
years.
But it doesn't
the
have
economy is
doesn't take any money
no,
to do it.
I agree. In many ways, I agree, but it's also under more pressure than it's ever been.
And look,
in
you got to
many
plan
years
for the
to
future
fund-
just because you're doing well now.
I agree. This is the time to take stock, make a reinvestment, particularly in order to retain and attract that young workforce.
Great opportunities now, if it's planned.
I realize that you won't believe it, but 59 minutes have gone by. We've had fun, and I think my audience and your host has got some good insight from a variety of key leaders in the real estate market. I'd like to thank Ken Swig of Swig Burris Equities, Mr. Downtown Manhattan, who's also doing some condo developments on the west side. U-Haul, our lender, our friend, our investor from Gramercy Capital. Adam Popper from Beacon Capital Partners, Bruce Mosler, the small little company called Cushman & Wakefield. All kidding aside, and congratulations, Bruce, being named international president this January. I know you're going to do a great job.
Thanks,
Richard Mack, Apollo Real Estate Partners, and I know you love the West Side and Hoboken, which we didn't get a chance. Alan Riley, president of Alan Riley Company. I hope that you'll come back. We'll be able to continue, and next month we're going to be talking a little bit more specifically on some residential developments around the tri-state area, including New Jersey. Thank you very much. Good night.
Funding for the Stoller Report is made possible by a grant from the First American Title Insurance Company of New York. The First American Corporation is the nation's leading diversified provider of business information products and services that impact the major events of people's lives.